Money, it's a gas. That's what Pink Floyd sang back in the day. And let me tell you, if money is fuel, the filling station is the Federal Reserve. I am Stevan Novakovic, Senior Economist for Farm Credit of Central Florida, and we are going to embark on a quick discussion of what we should expect going forward regarding inflation and employment. Let's start with that petrol pump. On November 2nd, we learned from Chairman Jerome Powell that the Fed would be raising the target rate by another 75 basis points. That's equivalent to 3/4 of a percentage point. This is the 6th hike of the year, with each of the last 4 being a whopping 3/4 of a percentage point, and establishes a new range for the Fed funds rate at 3.75% to 4%. What does this mean and why does it matter? Well, to put it broadly, it means money costs more for banks and thus higher interest rates for consumers wishing to buy a house, car, or start a business. But it also has implications for the U.S. Treasury market. Traditionally, the bond market has been called the smart money, and yields reflect the trade's expectations of future Fed funds rates and the overall health of the economy. In a typical environment, the term structure, also affectionately known as the yield curve, slopes upward. This results from the theoretical assumption that longer-term debt is inherently more risky, and as such a premium must be paid to the holder. Right now, however, the yield curve is doing something we don't see very often. It is sloped the opposite direction, otherwise known as being inverted. All right, what does this mean? Heightened risk. Traders, or purchasers of U.S. Treasuries, have priced in more hazard in the shorter-term maturities. For example, the 2-year Treasury note has an interest rate 1/2 of a percentage point higher than the 10-year note, the widest spread since 1981. Historically, the relationship between the 10-year and the 2-year has been a leading recession indicator, and right now it is flashing major warning signs. Basically, the current yield curve is indicating a considerable economic slowdown ahead and higher interest rates for the foreseeable future. On that positive note, you might be wondering, why is the Fed raising rates? Well, the primary reason is something we've all been facing at the checkout line over the past year: inflation. More specifically, things are getting much more expensive. The Fed has a goal of around 2% inflation per year, and from 2012 through 2020, during a period of very cheap money, that's more or less what the American economy accomplished. Unfortunately, the pandemic changed all of that. Looking all the way back into the ancient history of George W. Bush's presidency, it's clear that stimulus checks, i.e. infusing cash into the economy, boosts purchasing and thus prices. Over the pandemic, we had not 1, not 2, but 3 stimmies, not to mention all the loan forgiveness, industry bailouts, and additional unemployment benefits. While more dollars in the economy certainly drove spending, lockdowns caused consumer preferences to change in everything from housing to exercise to food and alcohol and more. Spending on services halted, and everyone went out and bought stuff. This created a domino effect as one-off purchases of unexpected items caught supply chains by surprise, resulting in long lead times and especially shortages, further driving prices higher. The Fed's main intent with raising rates, thus, is to reduce spending and control inflation. Here's a problem though. Early on in this inflationary period, the primary driver was energy costs, especially fuel. Well, gas isn't down as low as we would like it, but it has dropped noticeably. As the nation has reopened for business, however, services are back in demand, housing costs more, and food prices are rising due substantially to rising input costs driven by high energy costs to produce. The bottom line, expect prices to remain inflated for the foreseeable future across most complexes. Which brings us to our last topic, employment. Why is spending still so high? Well, a lot of people still have jobs, and most of those received inflation-related salary increases. Fed Chair Jerome Powell has specifically stated that pain will be felt in the employment sector as interest rates rise. But in September, the unemployment rate dropped again to a very low 3.3%. This further enforces the notion that rates are nowhere near high enough for Powell. If we look at the overall employment situation, however, it isn't great. In October, the total labor force was about 103,000 people below pre-pandemic levels. Close-ish, sure, but we need to remember that lockdowns occurred almost 32 months ago, meaning we are well below the growth trend. So, while the employment rate keeps dropping, that number is based on a labor force participation rate an entire percentage point lower than where we were before COVID. And while that may sound insignificant, in a country of over 330 million people, it starts to add up. In short, what this means for me and you out there is that we can expect interest rate increases to continue, prices in most sectors to keep rising, and unemployment should start growing. Until next time, that's all for now, folks.